Most people think you need tens of thousands of dollars, a finance degree, or a premium subscription to a Bloomberg terminal just to make money in the stock market. But the truth? 90% of beginner investors lose money within their first year. And it is not because the stock market is a scam or because they lack capital. It is simply because they buy random hyped-up stocks they saw on social media without a single piece of a real plan. They treat Wall Street like a casino, and then they wonder why the house always wins. In this video, we are changing that. We are building a rock-solid high-growth $1,000 stock portfolio completely from scratch. This is not a get-rich-quick scheme. There is no day trading, and there is no crazy options gambling. This is a proven, step-by-step blueprint that you can copy today, designed to build long-term wealth while protecting your hard-earned money. Welcome back to Equity Lab Media. If you are new to the channel, our mission here is simple: to break down the complex world of the stock market and help you build real, lasting financial freedom. Now, $1,000 might not seem like a massive fortune when you look at the multi-billion-dollar hedge funds on Wall Street, but thanks to the unstoppable power of compounding interest, this exact framework we are covering today is how financial empires are started. If you start with a strong foundation, time will do the heavy lifting for you. We are going to break this $1,000 portfolio down into 3 distinct strategic tiers: core stability, growth drivers, and high-upside accelerators. Every single tier serves a specific purpose in your financial ecosystem. And make sure you stay with me until the very end of the video, because I am going to share the #1 rule of portfolio maintenance. If you skip that rule, even the best stocks in the world won't save you from accidentally wiping out your entire account balance. Let us jump right into the first tier. Tier 1 is what we call the foundation, or core stability. We are allocating 40% of our total capital here, which equals exactly $400. There is a vital rule in wealth creation: you cannot build a skyscraper on top of quicksand. In the exact same way, you should never build a long-term investment portfolio entirely on speculative, highly volatile stocks. If your portfolio is top-heavy with risky companies, a single bad headline on the news can delete half of your net worth overnight. That is why our first $400 does not go into a single company. Instead, we are putting this cash into a broad market index fund, or an ETF, specifically an S&P 500 ETF. If you are new to investing, an ETF, or exchange-traded fund, is basically a basket of stocks. When you buy just one single share of an S&P 500 ETF, you instantly become a partial owner of the 500 largest, most profitable publicly traded companies in the United States. You are instantly investing in Apple, Microsoft, Amazon, Nvidia, Tesla, Berkshire Hathaway, and 494 other corporate giants, all at the exact same time. Historically, the S&P 500 index has returned an average of about 10% per year over the last many decades. Some years the market is down, and some years the market is up over 20%. But over the long term, it is one of the most reliable, wealth-generating machines in human history. This $400 allocation is your safety net. If one specific industry has a terrible year, the other sectors are there to lift you up, keeping your portfolio safe from total disaster. Now that our core foundation is safe and secure, we want to look for ways to beat the market average. That brings us to Tier 2, the growth drivers. We are allocating another 40% here, which is another $400. For this tier, we are going to split the money evenly and invest $200 each into 2 dominant blue-chip companies. But we aren't just picking any random household names. We are specifically looking for companies that possess what Warren Buffett famously calls an economic moat. An economic moat is a massive, structural competitive advantage that makes it nearly impossible for competitors to come in and steal the company's market share. For a beginner portfolio, we want companies that literally run the infrastructure of the modern world. Think about tech behemoths like Microsoft and Apple, or the semiconductor giant Nvidia. These companies do not just sell products, they control entire digital ecosystems. Microsoft practically owns the enterprise software market and is leading the global infrastructure charge in artificial intelligence. Apple has billions of active devices worldwide, and a consumer loyalty rate that is unmatched by any other brand on Earth. These businesses generate billions of dollars in free cash flow every single quarter. They hold massive amounts of cash on their balance sheets, and they have predictable, recurring revenue streams. By investing $200 into Microsoft and $200 into Apple or Nvidia, you are capturing aggressive, industry-leading growth, but you are doing it without taking on the reckless risk of unproven companies. Now that 80% of our portfolio is locked up in safe, steady growth, it is time for Tier 3, the high-upside accelerators. This is where investing gets exciting. The final 20% of our money, which is exactly $200, goes into this high-growth category. These are smaller, younger, and significantly more volatile companies that have the genuine potential to double, triple, or even 5 times in value over the next few years. Because these companies are earlier in their life cycle, they carry a higher risk, but they also offer the massive rewards that can supercharge your portfolio's total returns. When we look for accelerators, we want to look at innovators, dominating rapidly expanding industries. We are talking about sectors like cybersecurity, financial technology, cloud computing, or specialized global e-commerce. Great examples in this category include companies like Palantir, which handles heavy-duty data analytics and defense AI, or CrowdStrike, which secures global cloud networks, or Shop, which powers independent online retail. Because this tier is highly volatile and prices can swing wildly from week to week, we do not put all $200 into just one name. We split it down the middle, placing $100 into 2 different accelerator stocks. If one of these companies faces an unexpected setback, your 40% foundation in the S&P 500 protects your overall wealth. But if one of these accelerators hits a home run and explodes in value, it will drag the total valuation of your entire $1,000 portfolio straight into the stratosphere. But look, picking the right stocks and building this asset allocation is only half the battle. You could have the most perfect portfolio design on the planet, but it won't matter if you do not understand the golden rule of portfolio survival, dollar cost averaging. Setting up your initial $1,000 portfolio is a fantastic milestone, and you should be proud of taking that step. But the real wealth, the life-changing money, happens when you commit to consistency. Dollar cost averaging means that you commit to adding a set amount of money, whether that is $50, $100, or $200, into these exact same positions every single month, like clockwork. It does not matter if the stock market is at an all-time high, and it does not matter if the media is screaming that a crash is coming. By investing consistently over time, you completely remove human emotion from the equation. When the market goes down, your monthly contribution automatically buys more shares at a heavy discount. When the market goes up, your existing shares gain value. Over a period of years, this simple habit turns into an unstoppable snowball effect. If you want to know the exact specific stocks we are adding to our Tier 3 Accelerator watchlist right now, or you want to see a full deep dive analysis on our top blue chip picks, click on the video showing on your screen right now. Do not forget to hit the subscribe button and turn on notifications to join the growing Equity Lab media community. Thank you for watching, protect your capital, and I will see you in the very next video.